The dollar is collapsing right in front of our eyes, and most Americans have no idea what's about to hit them. While the mainstream media keeps telling you everything is fine, something catastrophic is happening in the currency markets that could wipe out decades of your hard-earned savings in a matter of months. I'm going to show you exactly what's happening, why it's accelerating faster than anyone predicted, and the one asset class that's acting as a lifeboat while paper currencies sink into oblivion. Let me start with something that should terrify every American with a retirement account. The dollar has lost over 90% of its purchasing power since the Federal Reserve was created. But here's what nobody's talking about. That decline is accelerating. What took 70 years to accomplish in the past is now happening in 7. The velocity of dollar debasement has entered a parabolic phase, and the smart money knows it. That's why they're flooding into physical metals at a pace we've never seen before. You want to know what real panic looks like? Look at what central banks are doing, not what they're saying. They've been net buyers of gold for 14 consecutive years now, but the buying has gone absolutely vertical. These are the same institutions that have access to every economic data point, every classified briefing, every backroom conversation about monetary policy. And they're dumping dollars and buying metal like their survival depends on it, because it does. Here's the part that should make your blood run cold. The BRICS nations, Brazil, Russia, India, China, South Africa, they're not just buying gold. They're building an entirely new monetary system designed to bypass the dollar completely. They represent nearly half the world's population and a growing share of global GDP. And they've made it crystal clear they're done with dollar dominance. When you see countries that have been adversaries for centuries suddenly cooperating on a gold-backed trade settlement system, you know something massive is shifting beneath the surface. Let me paint you a picture of what's happening right now in the physical metal markets. Silver just crossed $90 an ounce for the first time in history. Gold is trading well above $4,600. But here's what's really wild. The premiums on physical metal, the amount you pay above spot price to actually get your hands on coins or bars, those premiums are exploding. In some cases, you're paying 15 to 20% over spot just to get delivery. You know what that tells me? There's a massive disconnect between the paper price and the physical reality. The paper markets are saying one thing, but the real world is screaming something completely different. Think about what a premium means. It means demand is so intense that dealers can't keep inventory on the shelves. It means refineries are running at maximum capacity and still can't keep up. It means the gap between people who want to own paper promises and people who want to hold actual metal in their hands is widening into a chasm. And when that gap gets wide enough, something breaks. We saw it in nickel markets recently. We saw it in lumber. We're about to see it in precious metals, and when it happens, it's going to be spectacular. Now, before we go deeper into this, I want to mention something quickly. If you're watching this and you've got retirement savings you're worried about, I put together a free guide that shows the saving secrets thousands of American retirees are using to protect their hard-earned wealth. It's in the description below. No cost, no obligation, just information that could make a real difference in how you weather what's coming. Grab it while you're thinking about it, then come right back because what I'm about to show you next is crucial. Let's talk about the mechanics of what's actually destroying the dollar. It's not just inflation, though that's part of it. It's not just government spending, though that's accelerating out of control. It's something more fundamental, the loss of reserve currency status. For 80 years, the dollar has been the world's reserve currency. That means every country needs dollars to buy oil, to settle international trade, to hold as reserves in their central banks. That created artificial demand for dollars that allowed the United States to print money with relatively few consequences. But that privilege is ending, and when it ends, all those excess dollars are going to come flooding back home. That's when the real inflation hits. Here's an analogy that might help this click. Imagine you're at a party, and you've been writing IOUs all night for drinks, food, everything. As long as everyone at the party believes your IOUs are good, you can keep writing them. You can consume way more than you produce because people are willing to hold your paper promises. But the moment people start doubting those IOUs, the moment they start demanding real payment instead of paper, you've got a problem. That's where we are with the dollar. The party's ending, and the bill is coming due. The technical picture in metals is absolutely screaming right now. Gold broke out of a multi-year consolidation pattern and never looked back. Every pullback gets bought immediately. Every dip finds a floor of buyers waiting. That's not retail speculation. That's institutional accumulation. That's central banks. That's sovereign wealth funds. That's the people who manage trillions of dollars and have access to information you and I will never see. They're positioning for something big. Silver's even more interesting because it's both a monetary metal and an industrial metal. The industrial demand alone is staggering. Every solar panel needs silver. Every electric vehicle needs significantly more silver than a traditional car. Every 5G tower, every smartphone, every computer, they all need silver. And here's the kicker. We're mining less silver now than we were a decade ago. Primary silver mines are shutting down because they're not economically viable at lower prices. Most silver comes as a byproduct of other mining operations, and when those operations slow down, silver supply contracts. So you've got surging industrial demand, declining supply, and now you're adding massive investment demand on top of it. That's a recipe for a price explosion. Let me tell you a story that illustrates what happens when paper markets collide with physical reality. Back in the early 2000s, there was a massive short position in silver. A few large banks were essentially betting that silver prices would stay suppressed. They were selling paper silver contracts, promises to deliver silver they didn't actually have, in quantities that dwarfed the available physical supply. For years, this worked. They could manipulate the paper price down, trigger stop losses, shake out weak hands, rinse and repeat. But then something changed. Physical buyers started standing for delivery. Instead of just trading paper contracts back and forth, they said, "No, I want the actual metal." And suddenly the banks had a problem. They'd sold far more silver than they could actually deliver. The price didn't just rise, it exploded. We went from single digits to nearly $50 in a matter of months. That's what happens when paper games meet physical reality. We're setting up for that same dynamic right now, except on a much larger scale. The short positions in both gold and silver on the COMEX are enormous. The ratio of paper claims to physical metal is somewhere between 100 to 1 and 200 to 1, depending on who you ask. That means for every ounce of actual metal in the warehouse, there are 100 to 200 paper claims on that same ounce. As long as everyone's happy trading paper, the system works. But the moment a significant percentage of those paper holders say, "I want the real thing," the whole structure collapses. And here's why that moment might be closer than anyone thinks. Trust in institutions is at all-time lows. Trust in government, trust in banks, trust in the financial system, it's all eroding. When people lose trust in institutions, they want tangible assets. They want things they can hold, things that can't be printed, things that have held value for thousands of years. That's why we're seeing this surge in physical demand. It's not speculation, it's fear. It's people looking at their bank statements, looking at their retirement accounts, looking at the purchasing power of their savings, and realizing that the numbers might be going up, but their actual wealth is evaporating. Let's talk about what happened in Weimar Germany, because there are eerie parallels to today. In the early 1920s, Germany was dealing with massive war debts and reparations. The government's solution was to print money. At first, it seemed to work. People had more money in their pockets. Businesses were booming. The stock market was going up. But then something shifted. People realized that the money itself was becoming worthless. A loaf of bread that cost 1 mark in the morning cost 10 marks by evening. Workers demanded to be paid twice a day so they could spend the money before it lost more value. People who had saved their whole lives in German marks saw their wealth completely destroyed. But you know who survived? The people who owned real assets, land, businesses, and especially gold and silver. While paper wealth evaporated, tangible assets held their value. We're not in Weimar Germany, but the dynamics are similar. Massive government debt, central banks printing money to finance that debt, and a growing realization among the public that the currency is being debased. The difference is that it's happening in slow motion, which makes it harder to see. But make no mistake, the outcome is the same. Paper currency loses value. Tangible assets preserve wealth. Here's something that doesn't get talked about enough: the energy cost of mining metals. It takes an enormous amount of energy to extract gold and silver from the earth. You've got to move tons of rock to get ounces of metal. You've got to crush it, process it, refine it. All of that requires energy, and energy costs are going up. That puts a floor under metal prices because at a certain point, it's not economically viable to mine. But here's the interesting part. As energy costs rise, the value of metals rises even faster, because metals are a store of energy. They represent all the energy that went into extracting them. So in an inflationary environment where energy costs are soaring, metals become even more valuable as a store of that energy. Think about it this way. If it costs $1,500 in energy and labor to mine an ounce of gold, that ounce can't trade much below $1,500 for very long. Miners would shut down production, supply would contract, prices would rise until mining became profitable again. That's the floor. But there's no ceiling. The ceiling is determined by how much paper currency is being created and how much trust people have in that currency. And right now, currency creation is unlimited and trust is plummeting. That's a recipe for metals to go much, much higher. Now, I want to take a quick moment here because this is important. If you're sitting on retirement savings, if you've got $100,000 or more in a 401k or IRA, you need to understand that there are ways to protect that wealth from what's coming. I put together a comprehensive guide on how gold IRAs work. It covers how you can get physical gold into your retirement account without triggering taxes or penalties. It's not for everyone, but if you're concerned about the dollar, if you're worried about market volatility, if you want to hedge against the kind of monetary chaos we're seeing unfold, it's worth understanding your options. The guide is in the description. It's free, there's no obligation, and it could be one of the most important financial decisions you make. Check it out when you get a chance. But right now, let me show you what's happening with institutional money, because this is where it gets really interesting. Hedge funds are piling into metals, not the paper ETFs, the physical metal. They're taking delivery, storing it in private vaults, and sitting on it. Why? Because they see what's coming. They understand that when the next financial crisis hits, and it will hit, the Federal Reserve's only tool is to print more money. They'll call it quantitative easing or liquidity provision or whatever euphemism sounds less scary, but it's the same thing, creating currency out of thin air. And every dollar they create dilutes the value of every dollar already in existence. That's not a theory, that's mathematics. Let me give you some perspective on just how much money has been created recently. The Federal Reserve's balance sheet, which is essentially a measure of how much money they've printed, has exploded. We're talking trillions of dollars created in just a few years. To put that in context, it took the Fed nearly a century to get to $1 trillion balance sheet. Now they're adding trillions in months. That money doesn't just disappear. It flows into the economy. It chases assets. And it destroys the purchasing power of the currency. The only question is how fast. Here's where it gets really interesting from a market structure perspective. The COMEX, the exchange where gold and silver futures are traded, has a problem. They've got massive short positions, meaning traders' betting prices will go down, and relatively small amounts of physical metal in their warehouses. If even a small percentage of contract holders demand physical delivery instead of cash settlement, the exchange could face a delivery default. That would be catastrophic. It would expose the fact that the paper market is a fiction, that there's far more paper metal trading than actual metal in existence. And when that happens, the price discovery mechanism breaks. We'd see prices gap up violently as the market reprices based on physical scarcity rather than paper abundance. There's historical precedent for this. In 1980, the Hunt brothers tried to corner the silver market. They bought massive amounts of physical silver and silver futures. As they took delivery, the available supply shrank and prices skyrocketed. Silver went from single digits to $50 in a matter of months. The exchanges changed the rules mid-game, raising margin requirements and limiting positions, which eventually broke the Hunt brothers. But here's the thing, they were individuals. What's happening now is much bigger. It's sovereign nations, central banks, institutional investors, all moving in the same direction. You can't change the rules to stop that. The market will have to adjust. Let's talk about what this means for the average American. If you're holding dollars, whether in a savings account, a money market fund, or under your mattress, you're losing purchasing power every single day. The official inflation numbers are a joke. They don't include food and energy, the two things you actually need to live. Real inflation, the kind you experience when you go to the grocery store or fill up your gas tank, is running much higher than the government admits, and it's accelerating. But here's what's really insidious about inflation. It's a hidden tax. The government doesn't have to raise your taxes explicitly. They just print more money, which dilutes the value of the money you already have. It's the same effect as a tax, but it's harder to see and harder to fight. And it disproportionately hurts savers, retirees, people on fixed incomes. If you worked your whole life, and saved $1 million for retirement, and inflation runs at 10% a year, you're losing $100,000 of purchasing power annually. That's devastating. This is why metals matter. They're not an investment in the traditional sense. They don't pay dividends or interest. They just sit there. But that's the point. They maintain their purchasing power over time. An ounce of gold today buys roughly the same amount of goods and services that an ounce of gold bought 100 years ago. Can you say the same about the dollar? Not even close. The dollar has lost over 95% of its value in that same time frame. So when people say gold doesn't generate returns, they're missing the point. Gold preserves wealth. It's insurance against currency debasement. And in an environment where currency debasement is accelerating, that insurance is becoming more valuable by the day. Let me tell you about what happened in Cyprus back in 2013, because it's a preview of what could happen here. Cyprus had a banking crisis. The banks were insolvent. The government needed a bailout. But instead of bailing out the banks with taxpayer money, they did something different. They bailed in the banks by confiscating depositor funds. If you had money in a Cypriot bank, you woke up one morning and a significant percentage of it was just gone, taken, converted to bank equity. People who thought their money was safe in a bank account learned a hard lesson. When the system is under stress, your deposits are not as safe as you think. Now, I'm not saying that's going to happen here tomorrow, but the precedent has been set. The idea of bail-ins, where depositors take losses to recapitalize banks, is now part of the official playbook. It's in the Dodd-Frank legislation. It's been discussed at international banking conferences. The infrastructure is in place. And when the next crisis hits, when banks are failing and the government is looking for ways to stabilize the system without printing even more money, don't be surprised if they reach into your account. This is why physical assets matter. You can't bail in gold sitting in your safe. You can't confiscate silver coins you're holding. They're outside the banking system, outside the reach of desperate governments looking for assets to seize. That's not paranoia, that's prudence. It's understanding that in times of crisis, the rules change, and the people who survive are the ones who prepared. Here's another angle that's not getting enough attention. The industrial demand for silver is about to go parabolic. We're in the early stages of a massive energy transition. Solar panels, electric vehicles, 5G infrastructure, all of it requires silver. And we're not talking about small amounts. A single solar panel uses about 20 grams of silver. An electric vehicle uses 2 to 3 times as much silver as a traditional car. Multiply that by millions of units being produced annually, and you're talking about enormous industrial demand. But here's the problem. Silver supply is constrained. We're not discovering new silver deposits at the rate we're consuming existing ones. Existing mines are depleting, and it takes years, sometimes decades, to bring a new mine online. So you've got surging demand running headlong into constrained supply. That's a setup for a massive price spike. And unlike gold, which is primarily a monetary metal, silver has this dual nature. It's both money and an industrial commodity. That means it benefits from both monetary demand, people buying it as a store of value, and industrial demand, companies buying it because they need it for manufacturing. When both types of demand are surging simultaneously, which is what's happening now, the price dynamics get really interesting. We could see silver outperform gold by a significant margin in the coming years. Let's talk about the gold to silver ratio, because it's telling us something important. Historically, the ratio of gold price to silver price has averaged around 15 to 1, meaning it takes 15 ounces of silver to buy 1 ounce of gold. Right now, that ratio is much higher, though it's been compressing. When the ratio is high, it suggests silver is undervalued relative to gold. And when that ratio starts to compress, when silver starts catching up to gold, the moves can be explosive. We saw this in 2011 when silver went from teens to nearly 50 in a matter of months. The ratio compressed violently, and silver massively outperformed gold. We could be setting up for a similar move. Here's something that should concern every American. The national debt is now so large that it's mathematically impossible to pay it back through traditional means. We're talking about tens of trillions of dollars in debt, and that's just the official number. If you include unfunded liabilities, Social Security, Medicare, government pensions, the real number is over 100 trillion. There's no scenario where we grow our way out of that. There's no scenario where we tax our way out of that. The only way out is to inflate our way out, to debase the currency until the debt becomes manageable in nominal terms, even though it destroys the purchasing power of everyone holding dollars. This is not a conspiracy theory, this is official policy. It's called financial repression. You keep interest rates below the rate of inflation, which means savers lose money in real terms, and you use that negative real rate to erode the value of the debt. It's a wealth transfer from savers to debtors, and the biggest debtor is the government. So if you're a saver, if you're a retiree living on fixed income, you're the one getting robbed. And the robbery is accelerating. Now, let me show you what smart money is doing. They're not just buying metals, they're buying mining companies, particularly the junior miners. These are small companies with promising deposits that haven't been fully developed yet. When metal prices rise, these companies can see their valuations increase by multiples. It's a leveraged play on rising metal prices. But it's also riskier because these companies can fail. They can run out of money. They can have operational problems. So it's not for everyone. But for people who understand the sector and are willing to take on more risk for potentially higher returns, junior miners can be incredibly lucrative. The major mining companies are also interesting. They're generating massive cash flows at current metal prices. They're paying dividends. They're buying back stock. And they're still trading at relatively modest valuations compared to the broader market. Why? Because most investors don't understand the sector. They think of mining as old economy, dirty, risky. But the reality is that these companies are printing money right now. And as metal prices continue to rise, they're going to print even more. Here's a question you should be asking yourself. What happens when the next recession hits? And it will hit. We've had the longest economic expansion in history, fueled by unprecedented monetary stimulus and government spending. But that can't continue forever. When the economy contracts, when unemployment rises, when tax revenues fall, the government's going to have a choice. They can either cut spending, which is politically impossible, or they can print more money. What do you think they're going to choose? They're going to print. They're going to print trillions. And every dollar they print is going to flow into hard assets, into things that can't be printed, into metals. This is why positioning now, before the crisis hits, is so critical. Once the crisis is obvious to everyone, once metals are making headlines and prices are soaring, it's too late. You'll be buying at the top, chasing the move. The time to position is when things seem relatively calm, when most people aren't paying attention, when you can still get physical metal at reasonable premiums. That window is closing. Let me give you one more historical parallel, and then I'll bring this home. In the 1970s, we had a similar setup. Massive government spending on the Vietnam War and Great Society programs. A Federal Reserve that was too loose with monetary policy, rising inflation, a loss of confidence in the dollar, and gold and silver went on an incredible run. Gold went from $35 an ounce to over $800. Silver went from $1.50 to $50. People who owned metals during that period preserved and grew their wealth. People who stayed in dollars got destroyed. We're in a similar setup now, except the numbers are bigger. The debt is bigger, the money printing is bigger, the loss of confidence in institutions is bigger, which means the move in metals could be bigger. We're not talking about gold going from 35 to 800. We're talking about gold potentially going from current levels to 5,000, 6,000, maybe higher. And silver, with its dual demand dynamics, could see even more dramatic moves. So what do you do with this information? First, educate yourself. Understand what's happening in the monetary system. Understand why metals matter. Don't just take my word for it, do your own research. Second, consider allocating a portion of your portfolio to physical metals. Not paper ETFs, not mining stocks, actual physical metal that you can hold. Start with whatever percentage makes sense for your situation. 5%, 10%, 20%. There's no one-size-fits-all answer, but having some exposure is better than having none. Third, think about your retirement accounts. If you've got significant money in a 401k or IRA, understand that there are ways to get physical metal into those accounts through a gold IRA. It's not complicated, but it does require some paperwork and working with a custodian who specializes in precious metals. And here's the thing, this isn't about getting rich quick. This is about preserving what you've already earned. It's about making sure that the money you've saved over decades of hard work doesn't evaporate because the government decided to print its way out of a debt crisis. It's about having a hedge, a form of insurance, against the kind of monetary chaos that's becoming increasingly likely. For those of you who've stuck with me this far, I want to offer you something special. That free guide I mentioned earlier, the one in the description, if you download it and you're an American retiree with at least $100,000 in any retirement account, you'll also get access to an exclusive one-on-one educational web conference. No obligation, no sales pitch, just a chance to talk with someone who understands this space and can answer your specific questions about your situation. It's only available to people who watch this video all the way through and mention it when they reach out. So if that's you, take advantage of it.